If you have spent 30 years saving like a champion and still cannot decide whether to do a Roth conversion this year, you are not confused because you are bad at math. You are confused because every expert is pointing at the same finish line from a different street and nobody handed you the map. Quick note before we dig in, this is general education, not advice for your specific situation. By the end of this video, you will have one number to set every January. You will know which tax thresholds are speed bumps and which ones are cliffs. And you will know the December move that lets your tax money earn interest for you, instead of for the IRS. Here's the part nobody told you. Fill the 22% bracket. Watch the IRMAA cliff. Convert as much as humanly possible. Convert nothing because rates are going up. Every one of those takes is partially right, and that is exactly the problem. Following any single one of them in isolation is costing super savers real money every year. And as of July of 2025, the old urgency story changed under your feet. The Tax Cuts and Jobs Act brackets are now permanent law, so the panicked rates are going up argument that sold 1,000 Roth conversion seminars is gone. That does not mean conversions stopped mattering. It means the honest reason to do them is no longer about the federal rate schedule. It is about something else entirely, and we will get there. You might be thinking, but isn't all this advice basically aiming at the same thing in the end? It is not. One school of thought is laser-focused on filling brackets. Another prioritizes legacy and tax-free inheritance. Another is built around Medicare premium management. Those are different objectives, and the right answer for you depends on which one you actually care about. A one-size-fits-all script written for a generic retiree cannot tell you that. A unifying framework can, because it lets every objective sit on the same dashboard. Now let me name who I am talking to, because if this is not you, the next 10 minutes will not land. You are a super saver. You spent your career maxing out the 401k, throwing extra at the IRA, living below your means while your coworkers leased cars they could not afford. That discipline built your retirement. And now that same discipline is the single biggest obstacle between you and a peaceful retirement because the optimization muscle that made you wealthy refuses to switch off. You sit there at 66 staring at a spreadsheet trying to find the perfect conversion amount and you cannot pull the trigger. Every dollar of conversion feels like a dollar lost. Now you might be thinking, isn't permission to spend more about psychology than financial planning? Fair point, and that counter perspective is real. Permission to spend without a sustainable income foundation is a fast track to running out of money in your 80s. So we are not handing out blank checks here. We are saying that for a true super saver who already has the foundation, the next bottleneck is almost always behavioral, not mathematical. Here's the reframe that changes everything. The risk for someone in your position is not running out of money. Yes, that risk is real for plenty of retirees, especially if inflation eats away at purchasing power for 20 years. But for the disciplined saver with a 7-figure traditional IRA, the threat shifts. The threat is losing control of your own income to the IRS. Required minimum distributions now kick in somewhere between age 73 and 75 depending on your birth year. And once they start, the IRS calculates how much taxable income you take out every single year, regardless of what you actually need to spend. RMDs do not care about your grocery bill. They do not care about your travel budget. They are formulaic, they are mandatory, and for a super saver, they almost always force out more income than you wanted. Picture this. You are 74 years old. Your house is paid off. Your spending is comfortable on about $90,000 a year, but your traditional IRA grew to $2.5 million while you were busy not touching it. The required distribution that year is roughly $100,000 on top of Social Security and a small pension. You did not need $100,000 of taxable income. You needed maybe $40,000. And here is what the extra income does to you. It piles on top of Social Security, making more of it taxable. It shoves you across an IRMAA threshold, which spikes your Medicare premiums for the next 2 years because of the Lookback rule. And you pay tax on every dollar of it at your marginal rate. That is not a tax problem, it is a control problem. And by the time it shows up, the window to fix it has been closed for a decade. That is why the 5 to 10 year stretch before RMDs begin is the most consequential planning window of your retirement. Once you cross 73, your room to maneuver shrinks dramatically. Before then, the moves you make compound for the rest of your life. So here is the one number framework that replaces every conflicting strategy you have heard. Every January, you set one target percentage of your portfolio that is going to come out of tax-deferred accounts that year. That single number includes both your spending and your conversions combined. You spend first from the traditional IRA all the way up to whatever your lifestyle actually requires, and then you convert the rest to Roth up to that target. That is it. One number, one annual decision. And that number quietly accounts for tax brackets, IRMAA cliffs, RMD projections, and your spending needs all at the same time, because you set it inside a written plan that already projects all of those forward. Why does this work where every other strategy stalls out? Because it stops asking the impossible question of which strategy is right, and starts asking the answerable question of which target percentage is right for your portfolio this year. It also dissolves the perfectionism trap. There is no perfect conversion amount. There is only a reasonable target executed consistently, year after year, in a window that closes when you turn 73. Now, are there situations where this framework needs adjusting? Absolutely. If you retired at 62 and you are buying health insurance on the open marketplace before Medicare kicks in at 65, those premiums can run anywhere from $1,200 to $2,500 a month for unsubsidized coverage. Cross certain income thresholds and your subsidies disappear in a way that can cost more than the conversion saves. So pre-Medicare retirees often have a smaller target percentage than the standard playbook suggests. Your situation will differ from any framework you see online, including this one. Treat what I'm sharing as a starting point, not a personalized plan. Now to the part that resolves more confusion than anything else, the difference between mile markers and cliffs. Tax brackets are mile markers. They are progressive, which means you only pay the higher rate on the dollars that actually cross over. For a single filer in 2026, the top of the 24% bracket sits at $201,775. For a married couple filing jointly, the top of the 22% bracket sits at $211,400. Crossing into the next bracket on $1 extra of conversion is not a catastrophe. Only that $1 gets the higher rate. Now you might be thinking, doesn't crossing a bracket sometimes cost more than just the marginal rate because of lost deductions or credits? Yes, and that nuance is real, especially for retirees in the IRMAA zone, where extra income can also affect Social Security taxation. So mile marker is the right intuition, but it is not a free pass to jump into the next bracket without checking the second-order effects. IRMAA thresholds are an entirely different animal. They are cliffs. Cross them by $1 single, and the entire surcharge applies for the next 2 years because of the look-back rule. There is no gradual phase-in. You either cleared it or you did not. So let me give you the actual numbers for 2026, because the source of truth here matters. The standard Medicare Part B premium in 2026 is $202.90 per person per month. For a married couple filing jointly, the no surcharge income threshold is $218,000, based on your 2024 income because of the 2-year lookback. Cross that line by $1 and you land in the next tier all the way up to $274,000. Each spouse now pays an additional $81.20 per month on Part B alone, plus another $14.50 per person on Part D. Add it all up, and the first IRMAA cliff costs a couple roughly $2,297 in extra Medicare premiums every year you stay above the line, in addition to whatever taxes the income itself generated. That is the cliff. For single filers, the no surcharge threshold is $109,000, and the first surcharge tier runs up to $137,000 with the same $81.20 monthly add-on. So even if you are unmarried and feel like the cliff is theoretical, it is actually at a much lower income level than you might have assumed. Now you might be thinking, the first tier is small, who cares? Even at the first tier, you are looking at $2,000+ a year for a couple, locked in for 2 years because of the look-back. Over a typical retirement that adds up to real money, and the threshold does not adjust meaningfully for inflation, which means more retirees fall over it every year. So the first cliff is not nothing, it is the warning shot. Let me show you what this means in practice. Picture a married couple, 68 years old with $1.5 million in a traditional IRA, looking at conversions. Their target percentage says they could convert $60,000 this year on top of their Social Security and pension. But running the projection, that conversion lands their joint income at $218,500. $500 over the cliff. They just bought themselves about $2,297 in extra Medicare costs for the next 2 years, to gain about $120 of additional Roth conversion benefit. That is the trade you do not make. Drop the conversion to $58,000 and you stay clean. Mile markers you can cross, cliffs you respect. Now to the question I get more than almost any other, where do I pay the taxes from when I do a conversion? Some advisors will tell you it does not matter, that net worth is net worth and the tax bill is the same regardless. From a pure end-state arithmetic perspective, that is mostly right. But the source of payment matters enormously for liquidity, for future RMD exposure, and for whether you push yourself across an IRMAA cliff while paying the very tax bill you set out to avoid creating. So the real question is not where to pay from. The real question is whether you have a written plan that projects the trajectory of your traditional IRA balance through your 70s and 80s, so you can see what the next 10 years of conversions actually do to your future RMD problem. Now to the December move that almost nobody knows about. Here is why December is the only month with full information. By December, you know your actual annual income, you know your actual deductions, you know what you have already converted, and you know exactly how much room you have left under your target percentage and under any IRMAA cliff. Try to make this call in February and you are guessing. Make it in December and you are calculating. Now, there is a reasonable counter to this. Some planners argue you should convert in January to maximize tax-free growth time inside the Roth. There is real merit to that argument, especially during market downturns when asset values are temporarily lower. So the honest answer is that December gives you certainty and January gives you growth runway. And the right answer for a given year depends on which one matters more for your situation. For most super savers worried about cliffs, certainty wins. Here's the bonus that actually puts a smile on a client's face. The IRS treats federal tax withholding from an IRA distribution as if it was paid evenly throughout the entire year, no matter when in the year you actually do it. So instead of writing 4 awkward quarterly estimated payments to the IRS starting in April, money that sits in their account earning nothing for you, you let your tax money keep working in your portfolio all year long. Then in December, you withhold the full amount from the IRA distribution that funds the conversion. The IRS treats it as on time, no underpayment penalty. And the difference between making 4 early payments versus 1 December withholding is the interest you earned on that money the rest of the year. Spread across thousands of retirees, that is, real returns nobody talks about. Just remember the safe harbor rule that makes this work. To avoid an underpayment penalty, your total payments need to hit either 90% of this year's tax liability or 100% of last year's. And that goes up to 110% of last year if your adjusted gross income was over $150,000 for a married couple filing jointly. Hit one of those marks via your December withholding and you are clean. Here's the screwdriver moment. Before the end of this calendar year, look up your prior year tax liability on line 24 of last year's Form 1040. Multiply it by 100 or 110% depending on your income, subtract whatever you have already had withheld this year, and that is the dollar figure you can pull from your IRA in December as a withholding-only distribution to lock in safe harbor. That number is your floor. Whether you also do a conversion on top of it is a separate decision, but knowing that number changes how you sleep in April. One more honest note. Roth conversion perfectionism becomes an excuse to do nothing, but thoughtful caution is not the same as paralysis. There are real reasons to be careful, including the fact that conversions are irreversible since the recharacterization rules went away years ago. So the goal is not perfect. The goal is reasonable, executed consistently, validated in a written plan that projects your situation through your 80s. Let me close the loop we opened. The question we started with was, which Roth conversion strategy is actually right? The answer is none of them, and all of them. The right strategy is the one that starts with your target percentage every January, that respects the IRMAA cliffs while shrugging at the tax bracket mile markers, that uses December for execution, because that is when you have the information, and that lives inside a written plan you can see on one page. That is the framework that beats every individual strategy, because it includes them all. If you are the super saver I have been talking to this entire video, the next move is the simplest one. Find your prior year tax liability number this week, set your January target percentage for next year, and put the December conversion review on your calendar right now. This is general education, not personalized advice. Before you act on any of this, talk to a qualified financial advisor and a CPA who can run your actual numbers through your actual plan, because your situation has details a video like this cannot see. And there is one age that bends every IRMAA calculation in this video in a way most retirees never see coming. There is a single year in your 60s where the income decisions you make echo straight into the Medicare premium your spouse pays for the rest of their life. And most people only learn about it after they have already crossed the line. That is the next video in this series. And if the cliff math we just walked through made you nervous, the timing of that one specific year is the missing piece. Click play, and I will show you which age it is and exactly why it matters.